Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, I closed out last week's show by commenting on how the market remains obsessed with the 10-year US Treasury yield. At that point, the 10-year US Treasury yield remained in its downtrend and sat at 1.29%. I highlighted how we'd seen a run of higher lows in the preceding weeks, which meant that downtrend was being tested, and much depended on whether yields finally managed to break higher. And I summarised that if the 10-year US Treasury yield broke above 1.3%, then it would be interesting, and then once again, we would probably see a lot of equity market rotation, just as we've experienced a number of times already this year. Now, fast forward to a week later, and admittedly it's a shortened week as equity markets were closed in the US on Monday, and bond yields have broken higher, almost right on cue after managing to break the 1.3% level, and therefore that downtrend channel that I've been talking about in recent videos. The 10-year US Treasury yield burst higher towards the 1.4% level and currently sits at just below 1.36%. It means that the short-term trend in US Treasury yields has shifted upwards as long as it can stay above that 1.29 to 1.3% level. As a result, we've seen a big equity market rotation on Tuesday in the US, and the stagflation favouring sectors were hit hard on the day. Utilities fell 1.32%, real estate shares fell 1.11%, and by contrast, financial shares and energy stocks only fell 0.6%. Now, these are the sectors that were reflation trade beneficiaries in the past. But interestingly, healthcare stocks, which had been one that probably would benefit from stagflationary conditions, only fell 0.6% as well. So perhaps that latter is a nod towards the concerns over the rising COVID numbers around the world. However, despite disappointing jobs data from the US on Friday, the market narrative has shifted, and it shifted from one that was focused on stagflation and continued monetary support from global central banks to a narrative now that is concerned that central banks will begin removing support, hence the rally in the US Treasury yield in the last few days. But the rise in government bond yields wasn't just a US phenomenon. If you looked over into the UK, the 10-year UK gilt yield hit a 2-month high this week, when it currently sits at 0.72%. And again, traders have begun betting that the US Federal Reserve will reduce its £120 billion monthly bond purchases. And likewise, traders are starting to increase bets that the European Central Bank, the ECB, may announce a reduction in its own bond buying QE program at this Thursday's meeting. So that's why we've seen bond yields shift higher in the European Union as well, in the Eurozone. Now, the shift in narrative hasn't just hit bond yields. And although we've seen bond yields rise on both sides of the Atlantic, it's also caused some equity market weakness. Now, the German DAX, for example, is down about 1.3% today as I make this show, while the major UK stock market indices are down around about 0.6%. US equities are currently, although they've only just opened, they are currently down a similar amount. So equity markets are starting to show some signs of weakness. Now, there is no sign at the moment that these moves in bond and equity markets will continue or indeed accelerate, but it highlights once again how markets are trying to front run central banks. That kind of will they, won't they narrative when it comes to removing monetary stimulus is likely to continue in the coming days and weeks ahead, right up until the Bank of England and the Fed's own policy meetings occur on the 23rd and 22nd of September, respectively. So it's a case of hang on to your hat. If the Fed in particular gets things wrong and is deemed to have tightened monetary policy prematurely, then you only have to go back to the autumn of 2018 to see the potential impact. To give you a hint, if you go and look at the charts, US stocks fell more than 20% into the year end, dragging global equity markets with them. So there's a lot going on out there at the moment. Narratives are shifting back and forth. Right now, the markets are obsessed with what central banks might or might not do in the coming days and weeks ahead. So keep an eye on those headlines. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, Money to the Masses with a number 2. Of course, we're on Instagram, Facebook, TikTok, and don't forget to subscribe to our YouTube channel.